Hello, everybody. Mike Preston here at New Harbor. It is Thursday, September 28th. We wanted to just share a couple pieces with you this week, a couple pieces of information, let you know what we're looking at, what we're concerned about, what we're not concerned about, and what we're doing to adjust portfolios. There hasn't been a lot of adjustments lately, but there's been some small ones, and I'm going to go through each of those in just a moment. First, I'd like to share my screen and just talk about a couple big picture items. This is a chart from the St. Louis Fed. This is the Federal Reserve's data, and this is all about Treasury yields. So we have just lived through over 10 years of 0% interest rates. This was after the Great Recession in 2008. The system had to be recapitalized. The banking system had to be recapitalized. And the way that was done was pushing rates to zero. The negative effects of that is that it's caused the greatest bubble in financial assets in our lives, in my opinion. And the way that those gains were distributed, the way that purchasing power was distributed was very unfair and uneven. So we've seen a very large wealth concentration or transfer of wealth from the many to the few, and that has not been good. In terms of what it's done to the yield curve, so the yield curve has gone highly inverted at this point, and it's been there for almost 2 years. This is the 10-year Treasury interest rate minus the T-bill rate, the 3-month Treasury rate, and you can see here that we've been inverted on this curve for almost 2 years. This chart goes back quite a ways, all the way to 1982, so it goes back about 40 years. Each time the yield curve is inverted and then hooks up and goes positive, there's a recession. The recessions are denoted by these gray sections. I think that we hardly saw a recession in 2020. This was the COVID time frame, but still the yield curve got inverted there, uninverted, and we had a recession. That, of course, that recession was rescued by nearly $7 trillion in new money that was introduced into the system. But now we have a yield curve that's been more inverted than ever in the last 40 years and is strongly hooked up. It has not become uninverted yet. It's our opinion that it will become uninverted. And it's a sign of a sick economy. And it's a danger sign, but nothing has mattered quite yet. I'll show you on some of the other stock charts in just a moment. Nothing's mattered quite yet, but I think it will quite soon. Going on to the next chart. This is right off of our system at Schwab. This shows you what the yield curve looks like if you're to buy Treasury bills. A lot of you are interested in Treasury bills. We are holding essentially 50% Treasury bills at present, and we think they're a great place to sit while we're waiting for better opportunities. Take a look here at this row, the 3-month Treasury bills at 5.47. It's about the same out to 6-month, 5.5, 9-month, 5.5, 1 year, 5.5. And then it drops. It drops to 5.2 on the 2-year. But we're starting to look at some longer duration for some of you that are not needing the money anytime soon or just wanting to park cash. We've been suggesting that you go out to 1 year or 2 year on some of this money. You can always sell it early. The problem with selling it early is if interest rates keep going up and you go out further to 1 or 2 or 3 years, you could be facing a loss on that bond. The risk isn't great, and there's always a chance you could sell it at a gain, particularly if we get a big stock market drop and interest rates come back down again. But I thought it would be interesting to show you that the yield curve is pretty flat all the way out to about 2-3 years, and then it goes down. And this is the inverted yield curve. So if you look at the 3-month, we're at 5.5, and the 30-year is at 4.7. That's inverted by almost a full point. At some point, that'll change. And that could change by short-term rates crashing, but long-term rates staying pretty steady. It can happen a number of other ways too. So all of this, kind of feeds into the mortgage system, of course, because the 30-year mortgage is tied to the 10-year Treasury bond. So we have now had one of the biggest jumps that we've ever seen in mortgage rates. We went from about 2.5 up to about 7.5 now. We're actually seeing reports of higher, close to 8% or so. And while still historically, not that crazy, it's actually maybe back towards the historical average. It's the fastest jump on record. And the amount of house that you could afford with a fixed mortgage payment has fallen by nearly half. That's going to make a difference. Has not made a difference yet, surprisingly, because of the fact that, well, people can't sell. They don't want to lose their 2.5 or 3.5% mortgage, so they're not selling. Cash buyers that are flush with gains from the stock market or other places are paying cash for homes. That's going to end eventually. I don't know exactly when, but that's going to end. There's going to be a bear market in housing. I think it probably comes after the bear market in stocks. And it's you have to have a home to live. So we're not saying that you should speculate and sell your house and rent or anything like that. But if you're in a situation where you can wait a little bit longer, it's probably going to be better to wait a little bit longer to buy a house. So I'll stop sharing there, and I'm going to start sharing some charts instead. I wanted to talk about the stock market in general. I'll bring up that chart right now. So here's the S&P 500. The S&P 500, I think I'll start at a monthly chart, has been on a tear for years. Quantitative easing has created a market that just won't die. This is the COVID drop here, and I think that we saw the largest blow off top that we'll ever see in our lives after COVID because of the money that was printed there. Let's go to a weekly chart. On a weekly chart, you can see that 2022 was a down year, but it was very contained. It was very contained in this channel. You can see these downtrend lines. Back here at 0.2, it essentially tried to break out of that downtrend. It tested and then did indeed break out of the downtrend. And it's been really a 45-degree vertical move since then. Each time we've been thinking that this market is set to roll over, and it should. It went a little bit higher. And recently, actually, this whole consolidation was starting to look like a cup and handle consolidation. And a few weeks ago, we made some adjustments to our hedges to allow for the fact that this market could break out and move higher. We didn't completely take our hedges off. We sold our inverse hedges and we replaced them with an at-the-money put option that expires in December. And that essentially allows us to remain in the hedge, but have a fixed limit on how much we would lose on that hedge if we did indeed break higher. Well, as it stands, we actually broke lower. And if I go to the daily chart, you'll see here that the S&P has what looks like a head and shoulders topping formation. So here's the left shoulder, here's the head, and there's a double right shoulder. We broke below a few days ago. We broke below the neckline. That's right about here. And we've now confirmed. We'll see what happens in the next few days, but we're still below that neckline. And if this is the typical head and shoulders top, we should come right down to about 4,100 pretty quickly. So our short-term indicators have actually reversed into the negative. They were flirting with positive up here. We have a confirmed head and shoulders top breakdown. We still have a lot of complacency in the market and a low volatility. All of this says that we want to continue to hold a lot of cash waiting for better opportunities. I do believe we're going to see much lower levels relatively quickly once this continues to break down, which it should. We should come right to 4,100 or so with much lower levels possible thereafter. We have a plan for that. Our plan is to layer into the market slowly with our option hedges. But here's again the weekly chart of the S&P. We're up about 11% on the S&P. But if you look at some of the other indexes, for instance, the equal weighted S&P 500, flat on the year. The Russell 2000, which is mid-cap stocks, flat on the year. The S&P, as I pointed out, is up 11% on the year. If you take out the 7 strongest stocks, the so-called FANGs, then the whole market is flat on the year. So we have a market that, in my opinion, has been trying to top for a year and a half. We're still not higher than the January 22 high. And this market has just been aloft on hype. We're still where we were last March of last year when the Fed started raising rates. Yet meanwhile, long-term bonds have been absolutely pummeled. So I want to talk about TLT. You can see what bonds have done since last March of 22 when the Fed started raising. We think that this whole thing is an overreaction, but we completely understand that a lot of you are concerned about this position. So we have pretty small position in TLT at this moment. So we have a model position of about 15%, but that was reduced to about 7.5% when we got this breakdown back here. We sold October 106 call options on TLT, and we used that money to buy October 98 put options. That's this line. And so effectively, we're out of half of that position at 98. Just recently, we took profits on that 98 put, and we rebought November 92 puts. That keeps us out of half of this position. So at most people have maybe 6 or 7% exposed, because below 92 out to the end of November, we have no downside risk. Furthermore, we keep selling call options against the other half. So we're bringing in like one trade was $1.40 a few months ago. The last one was over $2. We keep selling call options on the other half. Eventually, we're going to get a sharp bounce, and the trade will improve. It's our opinion that we're in the middle of a capitulatory move in bonds. This is not sustainable, but so far it's gone further than most think it could. But the real point that most people need to understand is their position in bonds is well less than 10%, somewhere around 6 or 7% for most, because of the hedge that we have. And we've been collecting income on the short calls over and over again. And the put option, we just booked a nice profit on the put option. So we're happy to go through any of this with you individually. If you'd like, just give us a call. We'll schedule a Zoom or a Teams meeting. We'll do a screen share. We'll show you the transactions. But right now, we understand it feels uncomfortable because both TLT and GDX are down. And so that's causing us to be, at the moment, flat to slightly down on the year. That doesn't feel good. The important thing to notice or to realize is we have very little crash risk on the table. We're expecting the stock market to fall significantly, and we have a plan for that. And the positions that really do matter in the portfolio, like long bonds, TLT, and GDX, have some pretty good hedges on them. So there's not a lot of risk. There certainly is some risk, and hedges are not perfect because every hedge has a deductible attached to it, which is why you may see your account down 1%, 2% if certain things don't do well, like these two positions. But we're not invested in the stock market very much, depending upon how you look at it. We're maybe 5 to 15% exposed to the stock market, 5% if you don't count gold stocks, and about 15% if you do count gold stocks. We've got a whole lot of cash looking for better opportunities. We think those opportunities are coming soon. And we're happy to talk with you about your individual situation. So for that, I will wrap it up and see you next week. Thank you.